So let's talk a bit about what factors affect a loan, right? And that first step. I'm sure you know realtors are really excited to show property. That's what we love to do. We love to show property. And sometimes we admittedly don't always get the pre-approval first, and we get very excited. And then things end up not working out and we waste a lot of time.
Yes.
Right? So the first step, I think you'll agree, is to get those buyers pre-approved, pre-qualified. What's the difference in that terminology? Pre-approved and pre-qualified.
I'm so glad you asked that, Ronnie.
Because you hear that all
There's
the
a
time.
big difference between the two. So a pre-qualification means Mr. Buyer calls me up and says, well, my credit score is a 720. I've been at my job for 10 years. I make $50,000 a year. And they tell you what their situation is, but you don't verify it. And you and I both know that if we don't verify, it isn't real.
That's right.
So our team takes it one step further always. So a pre-qualification means they call you up, you call them up, you just get information, but you really don't know because you haven't pulled credit, you haven't seen those W-2s, you haven't looked at those self-employed tax returns, you don't know if they have money in the bank, you're just going off of what they tell you. What we do that's different is we're going to collect everything up front. We're going to get those W-2s. We're going to get those tax returns. We're going to look at the entire picture. And then we're going to determine what kind of program's best for them. But to get pre-approved is a stronger, more valid, hey, you're ready to put their butt in the car
There we go.
and drive them around.
Exactly. So when I think of it, I think pre-qualified what you said, pre-approved what you show.
Absolutely.
And pre-approved also includes a credit check. Tell us about that. Is it a soft pull? Is it a hard pull? Are buyers worried about the credit check?
So that's a great question, and I get that probably asked 5 times a day.
That's the number one thing people are worried about.
Absolutely.
Are you going to pull my credit?
Yes.
Yeah.
So the reality is, for the purposes of mortgage financing, a buyer has in a 30-day window, they can have it pulled as many times as they want, and it will not negatively affect their credit. And that's, I take that to the grave because I have been doing this a long time and know for a fact it will not affect the credit to have a lender pull it. But that is a misconceived notion that we get an awful lot. Now, I will preface that, Ronnie. If somebody goes to a car dealership and they have 5 different financing companies at the car dealership pulling it, they're going to have a horrible hit to their credit. And it's probably going to take about 60 to 90 days to recoup and get back to where it was.
Wow. And that happens a lot. People
lot.
go and buy cars and they have all these different
Lots
credit
of
unions.
inquiries.
Inquiries. Yeah, I know for sure. And that affects your credit score.
Yes.
And you're not just looking at one bureau, right? You're looking at an average of all 3, or how does that
All
work?
3, Experian, TransUnion, and Equifax. We're looking at all 3, and lenders are going to go off of the middle score of the 3 scores.
Got it.
Yeah, and just another thing I wanted to mention about that is if there are 2 borrowers, the score is going to go off of the lower of the 2 borrowers' scores. So that customer that comes to me and says, well, I have a 740, but my husband has a 530. Well, guess what? That 530 is what we're going to be looking at.
There we go. 100%. And so we talked about pre-qual, pre-approved, right? We want to go with pre-approval. Right?
Yes.
And there are 3 major factors that affect what somebody can afford and what you're going to approve them at. And those factors are debt to income, credit, and their actual income. So let's start with debt to income. What does that mean? That word DTI for new agents.
So DTI is debt to income ratio. And what that means is the amount of income divided by their debts currently is their front end debt to income ratio. So I'm going to say it again.
There we go.
The amount of gross income divided by their current monthly debts is the front end debt ratio. Now the back end debt ratio is their gross monthly income divided by the new housing payment and all of their debts combined. And that's the back end ratio. So depending on the loan product, whether it's FHA, VA, conventional, there are going to be different debt to income requirements for each of them.
Absolutely. So very masterfully put. Thank you there, Julia. I feel like I'm in college right now. You're learning all these things. No, but for a realtor, what we have to know is that DTI, how much debt they have, is a factor. You know,
Absolutely.
when buyers say, well, really, I don't know what really is involved. Well, you can say, hey, Julia doesn't explain it to you, but DTI is a factor. And then you do all those calculations based on what they show you, and then you get their number. Excellent.
Yes.
And then credit. We already talked a bit about credit. You said it was the average of the three.
Yes.
And then income. This is a big one because people will say, Ronnie, I work, I have this job where I get paid cash. And then I also take care of my neighbor's cat. And he pays me per month in cash. And then I have my actual job, W-2, but I have 1099, I have child support payments. All these things the buyer may think are income. But tell us, what do you look at when you look at a borrower's income?
Well, if it's a self-employed borrower,
1099, self-employed borrower, okay.
such as a realtor, and what we need to make sure is that we have 2 years of tax returns that are verifiable income on the tax returns. Okay. And the reason we do that is because if someone's business is going to be successful or not be successful, it usually it happens in the first 2 years.
Got it.
So that's why lenders want a 2-year history of self-employed. We wouldn't actually issue a pre-approval letter if somebody's self-employed without having those tax returns.
Those 2 years. So that's one form of income for a self-employed person, 1099. Tell us about the most common form, somebody that works at Target or Walmart or Publix, W-2, an employee. How would you calculate it then?
It's going to be pretty straightforward with a W-2 employee. But the first questions that we're going to ask is, are you full-time? And if you are full-time, are you paid hourly or are you paid a salary? Because those are looked at very differently. If somebody has not been with an employer as a full-time employee for 2 full years, we're going to be digging deeper. We're going to be seeing, okay, were they part-time before? Did they just become full-time? So there's a lot of different things that we're going to be looking at. And we're also going to look at variable pay. So someone who is a nurse, they're going to probably have some variable pay because they're going to work shift differentials. They're going to be having sometimes that they make double the amount of money that they would
good overtime, right?
Yes.
Rates, yeah.
Yes. Another employment that we see having variable pay is pilots and support staff on the planes, those kind of things.
People that travel, they get all these travel money, right? For
they per
back
diem and everything else.
So all this stuff may or may not qualify as income based on if it is going to be proven that it's sustainable and it's that it is what they call for a long time, right?
Correct.
Or it isn't just a fluke that they got, a big payment. It has to be proven that it's going to continue.
Correct.
Excellent.
That is correct.
So those are the factors, right? That I always wonder, man, how do they know how much you're approved for? So debt to income ratio, credit, and your income.